Yes.
Okay, welcome to the Smart Move, the podcast. This is one of our first episodes, so hopefully everything goes well. And I want to introduce Tracy Locke. She is an amazing mortgage broker, and I want to hand it off to her. Tracy, tell us a little about yourself.
Well, first, thank you so much for inviting me on. I love that used to be a client
Yes.
and now you're doing real estate. So I think that's really awesome. So
Yeah.
a little
Looking
bit
forward to
about,
growing our relationship more.
yes, for sure. I am a mortgage broker owner of Key Mortgage. I am located out in Katy, Texas, which is right outside of Houston. And I've got 23 plus years of experience in mortgage lending. Um, I'm a boutique type mortgage company in that I keep it small. I keep it small on purpose so that I can have more personalized relationships with my clients and my realtor partners. Um, and the other reason why I love being a broker is that I literally have access to all the programs available out there. I get to pick and choose who I want to do business with. And so that gives me a lot of flexibility with the type of guidelines that we deal with on different types of loans, and it just helps me provide um, better programs for all different scenarios. So that is what
Awesome.
I do, and I'm really strong with complex loans. That's kind of
Y-
like that's kind of what I'm known for around this area. Although I love the easy ones too. I actually do um, a lot of the hard stuff too.
Yeah, I think that's the reason why we met was because my loan was a little complicated after the divorce.
Oh, I don't
Yeah.
remember. It was a long
It's been a lifetime. Yeah, it's okay. So, what should buyers know before they start the mortgage process? Like, when should they start talking to you?
As soon as they think they might want to buy a house, I would say get with a reputable lender. Um, a referral, anybody, like a referral from your realtor, referral from your friends and family, just get with a lender. And sometimes I would recommend talking to maybe one or two different lenders, but a lender is going to be able to take a look at your scenario, take a look at your credit to see what you qualify for, what needs to happen. Say, for example, you come in and your credit isn't as good as it could be, and there's a little bit of time. They can help advise you and kind of give you some tips on how to get those scores up so that when you are ready to pull the trigger and actually go look for a home, you'll be in the best position to qualify for the best rates. They also give you an idea of what your comfortable payment is, because a lot of times people have it in their head that they want to live in a certain type of house, certain price range, and then they realize the payment might be too high for them. And so, one of the things I always encourage realtors and buyers to do is to get pre-qualified early so you know what those numbers look like. Because the worst thing is to go look at homes that are outside your price range, because if you have to come down and look at homes that are actually in your price range, sometimes that house that's 20, 30, $40,000 less is not going to be as beautiful or as nice as the ones that you've been
Mm-hmm.
looking at. So it's going to be a disappointment. So I would always say definitely get pre-qualified before you start looking at homes.
Yes. Yes. So, what are the biggest misconceptions people have about getting a loan?
The biggest one, actually, I still hear to this day, even though these programs have been around for a long time, is that you do not need 20% down to buy a house. You absolutely do not. There are, for first time home buyers on the conventional side, you can put down as little as 3%. FHA requires 3.5% down, and there's even down payment assistance now. So, depending on the area that you're in and the state that you're in, sometimes there's local down payment assistance programs that'll give you your 3% or 3.5% down payment. Sometimes it has a little bit of a higher rate, but if you don't have the funds and it's going to get you into home, sometimes it's really worth it to explore that option as well. Um,
Yeah, true.
Another thing is your credit doesn't have to be perfect. There are a lot of programs out there with flexibilities when it comes to not so perfect credit. So, for example, FHA, we can go down to 580. Um, and you can definitely, especially when you get with a good lender, if they look at your credit and there's some things that can improve, over the next 30 or 60 days, you can also get help from your lender to get those credit items fixed, or, work on it so that you are in a position to qualify for the best rate and for the loan program that you're looking for. Um, the other thing is lowest rate isn't always the best loan for you. I know there's a lot of online lenders out there where you just plug in all your information and it gives you the information. It doesn't always work out that way because they're not looking at the full picture. It's mostly AI that's running those scenarios nowadays. And then a lot of times it's marketing. So they're going to put their best foot forward and they're going to put and show you their best rate, but you may not qualify for the best rate. So definitely lowest rate isn't always the best option when it comes to lenders. And I don't know, it's not just about rate. I know a lot of people are rate sensitive, but it's also sometimes not everybody's situation is the same. And so structuring your loan is also really important. So,
hmm And how can buyers prepare financially before applying?
um, get with a good lender so that so they can look over your income and your debt. And
And they can kind of help you towards which debts need to be paid off sooner rather than later,
exactly.
right?
Like a lot of what
hmm
I do too is like I love first time home buyers. That's an exciting time. And I always go through budgeting with them. And it's
hmm
more than, what a lender should do. But a lot of times, like no one's ever taught them how to budget and what, the money coming in, the money
hmm
coming out. And like, do you really want to be house poor and spend all your disposable income on your mortgage payment? So, definitely know your income, know your debt, know your credit. Watch your bank statements because when we take an application, we're going to look at 60 days worth of bank statements and we're going to look at everything on there. So if there are large deposits on there that, that we see, we're going to want to source that. So like if it's, coming from a weird source or if it's cash, sometimes we may not be able to use that. So get with the lender, let them look at your bank statements and let them structure it for you because sometimes there's stuff on there that we just don't want to see, and so we will advise you to, hey, you know what? Maybe we should wait 1 month so that we can not show this particular statement when we submit the loan.
Yeah. Those 2 months worth of statements need to be really clean, right? Random
Exactly.
$5,000
Yes.
deposits, cash
And the other thing
deposit
is,
from
I
grandma or
know there's
something
there's a
like.
lot of people out there that love to transfer. They like to put, transfer money here and then transfer it back in. So all of those transfers have to be paper trailed. And so every time you do that, we're going to have to look at other accounts. So for example, if you provide your checking account statement, but you've got transfers from 4 other different bank accounts, guess what? We're going to have to document those 4 other accounts and the account that you just gave. So I would say keep transfers and whatnot to a minimum. Just plan to dump all your income into one account and keep it there until
hmm
you're ready to purchase. And
Okay.
the other thing is your credit. Don't go out and do a lot of inquiries. Make sure you make all your payments on time because even one skip payment or one late payment could be detrimental to your credit score. So just make sure you keep your
hmm
credit clean and make sure that you're not over the balance. I'm sorry, not over the set limit on your credit as well, because that also hurts your credit. And sometimes it doesn't look good either to a lender. Like if your credit limit's 2,000 and you owe 2,100, that doesn't look good. So
Yeah.
your credit report is kind of what gives the lender an idea of how you manage your finances. So it's really important to keep that as clean as possible.
Yeah. What other common mistakes can delay or hurt the loan approval process?
Um, let's see. Big ones are
Like a
job
last minute
changes.
vacation or, yeah.
Job changes. That's a big one too. A lot of times when people go from like W-2 wage earners to like a 1099 job, like that's a big deal because then you're going from, earning a wage to now being self-employed, and there's self-employment guidelines that are required, like, a 2-year history and whatnot. So if you're thinking about making a job change, definitely talk to your lender and say, hey, look, this is what I'm doing now, and this is what I'm thinking I want to do. Now, if it's just, uh, a change from company to company, you're doing the same line of work and the same type of income,
Yeah.
even more, but it's still W-2 wage earner, like that'll be fine.
That's not that big of a deal.
But
But
just
for
be
me,
careful.
like, decide you want to be a realtor.
Yeah, realtor, yes. Now
Yeah.
you're commission
Then,
based, you're 100%
yes.
commission based, because what we look at is stability of income. And if all of a sudden you switch to a type of income that is not stable and there's no history of it, we're going to have a problem. Um, the other thing is avoid big purchases, especially if you're financing them, because if I see your application, I qualify you based on the debt that you currently have. And then during the process, you go and you spend $10,000 on furniture, and now you've got a $400 monthly payment that I did not account for. That could throw off the entire, application,
Mhm.
the approval. And so that's a
Yeah.
big deal too.
So wait,
I've
so
seen a
wait to
lot.
buy the furniture until after
Yes.
you get the house, right?
And I'll tell you a story because that happened before.
Even if it's zero down and zero all that,
Oh,
it's
I've
still a
made a
debt.
client return everything before. It was that bad. Like, you need to go turn around and return all that furniture right now. And they did.
Yes.
So,
Good.
and the other thing is, just avoid moving money around. I think we talked about that a little while ago. Just try to keep everything in one account. If you have to, another maybe two accounts, but the moving money all over the place and moving money back in and out, like, that just makes it's a headache for you because you're going to have to document everything. And then also, um, it could reveal some other things that we don't want to see, because when we start looking at other accounts and whatnot, now you're subject to letting the underwriter look at everything that you have. And so it's just, sometimes we like to keep it as simple as possible. So just we want to see the fewest amount of documents, and
Yeah.
not have to question all your transactions. Because I know a lot of people are like, well, why do you need to know that? You're right, we don't need to know it, but if you gave it to us, we have to ask about it. So
Yeah, we got to be able to explain it and know where
exactly.
everything came from.
Just
Yeah,
stay
makes
consistent
sense.
and make sure that once you're under contract, anything that you do that you think might be questionable or might be a problem, talk to your lender.
Yeah, awesome. So, what other costs should buyers plan for beyond the down payment? Let's talk about earnest money, option money. What is that? Inspections, anything else?
Yeah, so upfront, you do have to put earnest money down, and that is what takes the home off the market, so that they're not continually they're not showing it to other people. So that home is yours, until they're not showing it. So it's yours until you close. Um, but the earnest money is usually about 1% of the sales price. There's an option fee in there too, and that gives you the option to cancel the contract within a certain period of time. And I think that's really what it is, right? Because the option fee is on
Hmm.
your side of it, so it
Yeah.
gives you that window to cancel without any penalties. Um, and then you've got your appraisal fees that you have to pay for. A lot of lenders charge for the appraisal fee up front, so that could range anywhere from $600 to $800, depending on if you need any additional schedules or anything like that. But that's what you can kind of expect to pay for as far as appraisal fees. There's third-party inspections, which require, I think, upfront costs as well. And I think third-party inspection, I think that runs four to $500, and I
Yeah.
definitely recommend that,
Yeah.
because the appraiser is in there for the lender, so they're just going to make sure that the value of the property is at least what the sales price is. And they will call out certain things, like maybe if there's like a huge, if there's a crack in the concrete, and it might be, they might mention it or whatnot. But a third party inspector is really going to get in there. They're going to look at everything, and they're going to let you know, like, things that they see behind the walls that you may not be able to see visually. But it could save you a lot of headache, because you don't want to get into a house that has hidden things in there that you don't
Hmm.
know about that may
Yes.
cause problems for you later. Um,
Right.
at closing, there's closing costs that you have to pay, and I usually tell people that's about 2 to 3% of the sales price. Now that you can always negotiate with the seller. Maybe the seller can help you with that cost. And what else is there? Then just your normal moving. Make sure you account for the cost of moving, because that's an expense as well.
Hmm.
Um, did I
You
do
might have a
everything?
new water account. You may have
Yes,
to put a deposit down for
exactly.
water, for electricity. You may have to be able to move it. You
Yeah,
may not. So there's lots
exactly.
lots of moving pieces.
There is a lot of moving pieces, and you don't want to basically spend all the money that you have. So it's a good idea to just make sure that you um, that you save a little bit extra, not just the down payment. You're going to need at least 3 or 4% more than the down payment to cover these other expenses as well.
Yeah. Okay. What trends are you seeing today in today's lending environment, and how's the war affecting interest rates right now?
So trends as in market, like interest rate trends.
Yeah.
So that's kind of a touchy subject for mortgage lenders right now, because they've gone up since February. So I think February we were in the fives. I think we were like at 5.75, and that's what we were predicting at the beginning of the year. Analysts were saying that, yeah, we can expect to be in the fives, come 2026. And that's what I was telling everybody, because that's what we were reading and that's what we were hoping for.
Mm-hmm.
Um, and then this war happened, unexpected war happened, and
Mm-hmm.
immediately interest rates shot up. So we started off in the low sixes, and then and we were kind of hovering around there because, it was like every other day, it was like, it's almost done, it's almost done.
Yeah, you're like
And it's just,
4.75. Nope. Then you're like
I
six,
know,
six,
yes,
two. Yeah.
yes, exactly. Because mortgage rates kind of like, the rates reflect what we anticipate to happen. And so
Mm-hmm.
when, you know, the news outlet in the media says, like, yeah, it's supposed to, the president says it's going to be wrapped up soon, like that causes like some positive energy in the market. And then rates come down a little bit and they're like, oh, actually, it's not going to happen. So it shoots back up. So the last 3 or 4 weeks have been pretty volatile.
Yeah.
It's like up and down, up and down. And, it has a lot to do with, what you guys are seeing on the news, when it comes to like
Mm-hmm.
what's happening and when is it going to stop, and oil prices and all the things and inflation. So definitely it's super volatile right now. But we're still in the low sixes. We're still in the low sixes, which,
I know
historically
people
that's
think that
still
that's,
good.
yeah, I know they're like, we got to wait for it to get back to three. And it's like, that was a
It's
historic
never going
low.
to go
You
back
don't,
to three.
yeah,
I do
we don't
not think
know.
I'll ever see three in my lifetime again. I just don't, unless like, like knock on wood, God forbid, like something like the pandemic happens again. But that was
Mm-hmm.
that was kind of, we will likely not see that again. And sixes, historically is actually pretty decent as
Mm-hmm.
far as rates go. Now, I think, once we get inflation back on track, because right now, like we're around 3%. I know the Fed wants to see it around 2%. We're kind of at a standstill right now and at a stall because of what's happening overseas in Iran and, oil prices and whatnot. And so I think that for the rest of the year, I mean, if we just assume that this is going to play out a little bit longer than we would all like, I think low sixes, mid sixes is where we're going to be for a while.
Mm-hmm. Yeah.
Um, and what I would say is for people that are looking at homes, prices right now are kind of, they have not jumped up, because if rates came down, I think prices would go up a lot more. And
Yeah, that's the
so
thing. Is like everybody's
I
waiting
think it's a
for
good time to
a
buy.
rate to
Yeah.
drop. Yeah, but then
Yeah,
prices start going up as soon as that happens. So
exactly.
yeah, that's kind of the
And
next question I was going to ask, was advice for anyone wanting to buy a home in the next 6 to 12 months. Don't wait for the rate to drop to three. What else could you say?
buy the house. I say if
Yeah.
you find the perfect house that works for your family and the payment is comfortable, um, buy the house, because you marry the house and you date the rate. I love to say
Mm-hmm.
that, because the rate can be changed. The rate can be refinanced as soon as rates come back down and you're at a level where it makes sense to financially refinance. You can refinance and you've already purchased your home and you already locked in that price, versus waiting for rates to come down, and all of a sudden now, if you were looking at a house that was 300,000, it could be now 325, 340, because rates are better. So you definitely want to lock in that price, because you can always refinance the rate.
Mm-hmm.
But you know, with that said, I think that there's a lot of good deals on the market right now. I really do. So especially, we're coming up on summer right now. People, when they start selling homes, they typically wait until the summertime, so that their kids are out of school and whatnot. So I think there's going to be more stuff on the market. And if you're looking for a good deal, I think there's still good deals to be had out there. Get yourself with a really good realtor and, a really good lender to work out the numbers and tell you what you can qualify for. And then, you know, you
Just do
might
it.
just be able to find the house that you love. You never know, but you
Mm-hmm.
won't know if you're not out there looking.
Right.
So
Yeah.
yeah.
True. True. Okay. So, what is one smart move buyers can make today to better prepare?
Um, I sound like a broken record, but talk to a lender. That's probably
Yeah.
the number one thing, because they're the ones that are going to tell you what your situation looks like now, if you're ready to do it now, or if you need to wait. If you need to wait 30 days, 60 days, maybe you need to wait 12 months, but they should be a good lender, will put you on a path, will put you on a plan to get into a home. And
Yeah.
then pair yourself up with a good realtor. Those two things right there, I think, is the best move that you can make if you're in the market to purchase a home. Getting a good
Yeah,
team
I
together, a
agree.
good
I
lender
see
team, and a good
it.
realtor team.
Yeah, I see it pretty often that they're house shopping without being pre-qualified or pre-approved. And so, yeah, you worry, or I worry, you don't want to show them a house that they can't really afford. Uh,
Yeah,
and they may
exactly.
think they can't afford it, but they don't really understand all the closing costs and everything that goes into it, and what that property taxes and insurance and everything that's going to
Yes.
be buying at the beginning of the year versus buying at the end of the year with prepaid property taxes and all that.
Yes.
It's a lot. It's a lot to
And
know.
lenders will be able to give you something in writing, like a worksheet, like a fees worksheet or a write up. They should be able to give you one anyway. Because a lot of people are visual people. Me telling you,
Mhm.
like, yeah, you need 3% and you need this and you need that may
Mhm.
not, like the reality of it may not hit you until you actually see it on paper. And a good lender should be able to put something, an estimate for you to give it to you on paper so that you can work that out. Take that home, digest it, work it into the budget that you have right now to make sure you're comfortable because, you know, 30-year mortgage, like, you're going to be stuck with it for a long time. So you want to make sure that it works for you and your family.
Yeah. So, for property taxes, can you talk a little bit about the difference of buying a house at the beginning of the year versus the end of the year and how they collect property taxes?
So you mean if you set up an escrow account?
Hmm.
Okay. So,
Yeah, the escrows at the beginning of the year.
the escrows at the beginning of the year are going to be the upfront escrow setup because when you set up an escrow account, we do as a lender, the lender servicer will require that you put like a 2 to 3 month reserve in there, and that's what you have to come up with initially at closing because we want to make sure that at the end of the year when your taxes come due or when your insurance comes due that we have more than enough to make that payment for you. So they always keep a little bit of a reserve in there. Now, it's not a fee, it's your money. It belongs to you. Just think of it as a savings account that the loan servicer has for you. Now, in the beginning of the year, that upfront cost is going to be just about, 3 to 4 months. Now, as you start closing towards the middle of the month and towards the end of the month, that amount is going to be higher, but it should be offset by the prorated taxes that we collect from the seller. So, for example, if you close in June, we're going to collect, we could be collecting maybe 9 months worth of taxes up front, but you're going to get a credit for 6 months worth of taxes from the seller. So that number
Hmm.
should offset, and you should end up with about, like I said, 2 to 4 months of reserves in that reserve account because you're going to be offset by the seller's prorated tax credit because
Yeah.
that tax bill is going to be your responsibility at the end of the year because you took possession of the house mid-year. And so on the closing statement, you'll see that credit from them because they owe the taxes for the amount of time that they lived in the house during the year.
Yeah. 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 That's good. I just wanted to kind of get that out there. It's just a little confusing and
And what I will
um,
say with that is when you buy a resale home, it's pretty easy. You don't really have to worry about that. It's when you get into new construction that it gets a little wonky. And the reason why is because the the tax valuation on your property is probably still land. So it's like,
mhm.
it's unimproved taxes. And so, you have your lender that may be collecting on improved taxes and that tax bill may be really low because they're still looking at, the value of the home when it was just dirt. And so there's kind of a
Mhm.
little bit of a gap there and it does cause problems sometimes because um I don't want to get into in the weeds with this, but like it just makes sure that when you buy new construction, that your lender is really explaining the unimproved versus the improved taxes and how that could affect your taxes later. Because when I see people and they are in big trouble because their payment shot up so much because they were uh, used to paying such a small tax amount on an unimproved tax amount and then it shot
Mhm.
way up. I'm pretty sure somebody told them, but they forgot. So,
Yeah.
that kind of messes people up sometimes and they end up having to sell the house. I've seen that happen where people have had to sell the house because the tax, that offset is too much for
Too
them to
much.
be able
Yeah.
to make up. Yeah.
Yeah,
So
it can
that's
be.
important.
Yeah, yeah, very, very important. Any other advice you have? I think that's about it on the questions I have for you.
I don't. It's just, I think that's the two biggest things. Get yourself with a good, reputable lender and realtor. If you've got a good team like that, that's going to be able to advise you on what you need to do, like, it should make the home buying experience a little bit more enjoyable. So,
Yeah, agreed. Agreed. Awesome. Well, thank you so much, Tracy Locke. I appreciate your
you're
time and
welcome, Brandy.
you interviewing with me on the Smart Move, and we'll see you soon.
Yes, thank you so much. Take care.
Thanks.
Thanks. Bye
Bye.
bye.